Do you assume now that the Fed could hike more than economic data really warrants because of the financial conditions and stability?
You know, I think it's interesting because we definitely saw a lot more concern about the inflation outlook in the minutes. But another thing we saw is this sort of pivot, like you were mentioning, toward financial stability concerns. But it's not clear that that is going to be a really convincing argument for some of the doves and more traditional economists on the committee, like Janet Yellen herself, people like Lael Brainerd, Charlie Evans. So while we are getting some more noise in the minutes from the more hawkish elements on the FOMC about financial stability, it's not clear that that's actually going to have a major impact on the rate outlook going forward, but we'll see.
Well, Mark, and that brings up the question is if the Fed sort of strays from their mandate, where their rules, where their models based for that, and they go more with financial stability, what is the risk then of a policy mistake?
Well, look, they've been teetering on the edge of that policy mistake for a while. You know, people thought they stayed low too long. They should have probably started raising back in 2013 when the economy was a little stronger. Now that the economy is actually weakening again, it looks like they are on the edge of a policy mistake. The problem is short end versus long end. They need the short end higher. It should be right around nominal GDP growth. But then they run the risk of the long end contracting, and you end up with an inverted yield curve and recession.
Mark Yusko, have we learned at this point, do you have any understanding on what addressing financial conditions actually means for risky assets?
Yeah, actually, the Fed speak is very challenging, as you guys know. Trying to interpret it every morning is something I don't envy. But I think when they talk about financial conditions, they created the financial conditions that they're talking about. You know, these asset bubbles. You know, we had the tech bubble back in 2000 when everybody said, oh, the markets the markets would never go down. Then they had the housing bubble when Ben Bernanke said housing prices could never go down. Now you've got the everything bubble. Everything from government bonds, as we're seeing over in Europe, to housing again, to financial assets is overvalued. And they're on a tightrope here.
Matt,